Good evening, everyone, and welcome to this Market Insight webinar. This is a series of monthly engagement wherein we aim to dwell into the interesting market trends, understand how equity market valuations are placed today across the market segments, and also discuss on our investment strategies. I am Niranjan. With me today, our Chief Investment Officer, Mr. Vetri Subramaniam, and Fund Manager, Mr. Amit Premchandani. In the last couple of years, a singular trend has driven markets fueled by good news, the rising tide of global stimulus, and resilience in domestic economy. And what we have actually seen in the recent past is that most of the pockets which were out of flavor for very long period of time or having long-term growth challenges to have actually delivered handsomely. This has actually triggered many questions among investors in terms of looking for suitable investment options today. With this backdrop, Amit, who is the fund manager for UTI Value Fund and also UTI Dividend Yield Fund, will actually take us through on the nuances of value investing, and he will also talk on the investment strategy that he follow under UTI Value Fund. Before Amit take over, we will actually begin the webinar with initial remarks from Mr. Vetri Subramaniam. So I would first hand it over to sir. Thank you, and over to you.
Good evening, everybody. Thank you for joining us on this edition of the Monthly Market Insight for Equity. I think Niranjan has already made the introduction. So I think without any further ado, we'll get moving. And as usual, what we'll do is first look at our presentation, which covers some sort of key macro insights that I hope you find interesting. We always tool around with some of the insights based on the kind of questions that we are experiencing, the kind of thoughts that you send in. So whenever you mail us in advance, it actually helps us prepare and keep our presentation more aligned with perhaps some of the questions that are on your mind. So we'll start now with the presentation, which should be visible up there on the screen. And as many of you know, because we've discussed this several times, there has been a very significant corporate profit boom in India, particularly from the years after the pandemic. So if you see the period starting FY20, the next 4 years have seen very remarkable growth and profitability, which you can see in this chart on the right-hand side in those yellow colored bars. So you can see in FY21 and then again in 22, 23 mild year, but then again in 24 back up about 20%. So very strong profit growth for the BSE 500 companies you can see on the right-hand side of this particular chart. But the question really is, what are companies doing with their profits? And what we've done in this chart is shown you one of the previous profit booms that India went through, which was during the period FY 2003 to 2008, which you can see on the left-hand side of this chart. Look at those green color bars. So profit growth during the period 2004 to 2008 was well over 20% per year CAGR, closer to actually a 25% CAGR through that 5-year period. Now, what we've also done on this chart is superimpose that blue line that you see, which is the free cash flow as a percentage of GDP of the BSE 500 companies. So the bars reflect the growth in profits, and the line reflects how much free cash flow are these companies generating. Now, if you're not familiar with free cash flow is the amount of cash generated by companies after they have engaged in capital expenditure. And what you can see during the period 2004-2008 is, even though profits are growing very rapidly, free cash flow as a percentage of GDP actually turns significantly negative, which means companies were making profits, but they were recycling those profits into new investments very, very aggressively. And this actually fueled the investment boom in the economy during that particular decade. But what is different about the last 5 years is that even though profitability has gone up, if you look at that blue line, it has sort of held up in positive territory. You can see that line over there. It's held up in positive territory because profits are not being recycled aggressively into investment. Now, you will recollect in many previous sessions as well, we've talked about the fact that government has done the heavy lifting in terms of capex, but the private corporate sector is yet to follow through. And effectively, this is another version of that same discussion point, which is at this point of time, businesses are not recycling their profits aggressively into new investments. They're actually throwing up free cash, and in many cases, they're actually distributing it through to the shareholders. So this is one chart that we wanted to share with you, which gives you the difference between the current thinking of companies in terms of their willingness to invest and how this was different from the cycle that we saw more than 20 years ago. I'll move on from this to another question that very often people talk about, which is how is foreign direct investment in India faring, FDI or foreign direct investment. Now, you will know that a few years ago, we saw some of the peak numbers for FDI in India. In FY22, FDI was almost about $85 billion. That's the reported number. But keep in mind that that is actually the gross number. Now, not only is there a movement of FDI into India, but sometimes because this FDI is coming from PE funds and venture funds, at a different point of time, they actually disinvest their holdings in India and repatriate their profits. In addition to that, Indian residents like you and me may also remit money out of India. For example, when many of you invest in schemes which have foreign investments, when you invest in, let's say, the ETF of a global index, then effectively you are remitting capital out of India. So what you are seeing in this chart is multiple components of foreign direct investments. The gray part of the bar reflects gross FDI coming into India. This could come from companies. For example, it could, the foreign investment which has come in from Apple gets counted here, but also foreign investment which has come in from PE and VC funds gets counted here. The light blue bar that you see in negative is the disinvestment. So, for example, if a large company sold its shares to Indian investors and repatriated that money home, that is what comes as the blue number, which is disinvestment from non-resident Indians. And finally, you have what I talked about earlier, which is outward capital flows by Indians. And then when you put all these three numbers together, you get the trend in terms of net FDI. Now, gross FDI actually peaked in the years of 20 and 21 at 43 and $44 billion. These were also sort of record years for gross FDI flows into India. But when you come to FY24, you find that net FDI into India has now dropped to just about 11 billion, not because India's attractiveness has completely evaporated. Gross FDI remains $71 billion, but there has been $44 billion of disinvestment. So this could include companies who have sold their shares in India. For example, we know there is a large auto company which is going to come out with a IPO. If that IPO is successful, then the money that goes back to the parent would classify as disinvestment by a non-resident, and therefore it reduces the gross FDI coming into India. So $11 billion, sort of a weak number, but we have to keep in mind that this reflects a lot of the flows of FDI into India coming from PE VC funds rather than from large multinationals. And that's why you have this reverse flow. And hopefully with many of the schemes and the ease of doing business, which India is now articulating, we will see more greenfield FDI. And that typically has a much longer cycle in terms of money starting to flow back outside. Having said that, even though this picture of FDI is disappointing, I think this is a wonderful chart, which actually tells you why human capital is so important. We spend a lot of time talking about investment. We spend a lot of time talking about the investment cycle, about the need to invest in infrastructure. But India's greatest strength, and it is arguably any economy's greatest strength, is actually its people. And our people who have, various skills. Sometimes these could be even low level skills. In many cases, these could be high level skills, doctors, engineers who work in areas like IT. These people go outside the country, they work outside in other geographies, but their earnings are significantly remitted back to India. So, in a sense, not only do we export IT services that all of you are familiar with, but we also export human capital. These are Indians who choose to go live and work overseas, but they remit many of their earnings back home to India. India is the single largest recipient of remittances among all countries in the world. In FY24, that number is above $100 billion at about $106 billion. So, really, when you think about people, people are our greatest strength. We have every reason to educate them, provide them with good health care, allow them to become productive citizens. And one of the reasons why you now see India in some of its free trade agreement discussions with different countries, we have also started talking about the need for those economies to provide visas to Indians, who particularly Indians with high skills, because in a sense, this allows our manpower to go overseas and work as part of these trade liberalization agreements, which typically historically only covered goods. They did not cover the mobility of labor, but we are now starting to incorporate that into our discussions about free trade agreements with different countries, because this is a source of strength. Our manpower is able to remit these capital flows back home. And I believe this is one of our underestimated strengths. Moving on from this, I think this month, or rather last month, marked a momentous decision whereby India got included in the key MSC JP Morgan Emerging Market Bond Index. And it is estimated that there will be almost about $25 billion of flow into India just from funds who are benchmarked to the JP Morgan Chase Emerging Market Bond Index. Now, this announcement was actually made in late September, October of 2023. And what we've shown in this chart is the fact that as soon as this announcement happened, you have already started to see an increase by foreigners in Indian government securities. These are known as the fully accessible route. And you can see that in the last, about 6 or 7 months, we have already seen about $12 billion of inflow. Some of this would have been the money which came in ahead of the inclusion in the bond index, but we still estimate that about $12 billion incrementally could come in on account of India's inclusion in the bond index, presuming that this 12 billion was essentially sort of advance purchases towards the same. But remember, there are several bond indices. There is also a Bloomberg index. There is a FTSE Russell index. And therefore, when you look at some of the investment banks, they now estimate $40 to $45 billion of inflow into India by foreign investors looking to have a base position in Indian fixed income. Indian fixed income has typically not really been on the radar of foreign investors, even though Indian and foreign investors have been investing in Indian equities all the way back from 1993. But in fixed income, their journey started only about in the last decade or so. And with this inclusion in the bond indices, we see more and more participation from them. One of the estimates suggests that as much as 5% of all central government G-SECs could be owned by foreigners within the next 18 to 24 months. So that's quite a significant development and a new source of demand for government securities. Moving on from this, finally, just a quick word on the currency. If you look at the left-hand side, you can see the performance of various currencies going back to December 22. Now, I won't blame you if you look at that blue line in the middle and think of that as being a flat line, because that's the value of the Indian rupee against the dollar. It is virtually unchanged over the last 1.5 years. It's almost as stable as the Singapore dollar, which is in some senses considered a very stable currency because it's a destination which receives a lot of capital flows, a little bit like being the Switzerland of the East. And the Indian rupee has actually been even more stable than the Singapore dollar over this 1.5 year period. You can see the behavior of many of the other currencies who have actually depreciated over this period, because we all know the dollar has been very strong, but the rupee has seen only marginal depreciation, more or less holding its ground and remarkably stable. On the right hand side, you see the rupee real rate, and that has moved in a very narrow band. The Chinese yuan has weakened quite a bit over the last 1.5 years. And that is a source of concern, because if it continues to weaken, I think all currencies and all economies will start to consider, the fact that their exports might get affected because China could gain export market share as a result of weak currency, and that would have its own set of ramifications. But as of now, Indian currency actually very, very strong, and maybe gives foreign investors another reason to look at Indian fixed income favorably. Moving on from this, we'll now quickly run through some of our regular slides. This is the update on economic indicators and forecasts. The the FY25 estimate on Bloomberg by professional economists is 7% GDP growth. Remember, this is much lower than what the RBI and government have been talking about. But there is almost a 50 basis point gap between what RBI and government are talking about and what professional forecasters estimate. So that's something interesting that we'll continue tracking. Moving on, high frequency indicators, not of much interest. So we'll just jump through to the earnings trend. You can see over here, the earnings expectation for March 25 and March 26 at the extreme right corner, 16% earnings growth estimated for March 25 and 15% for March 26. Main point I will make is that while we got 15% profit growth in March 2024, this was driven by EBITDA margin expansion, not by revenue growth. Revenue growth was in the high single digit. It did not go into double digit. So this year, if we expect earnings to grow 16%, it needs to be led a lot more by top line. EBITDA margin is unlikely to significantly boost this number any further. Moving on, this shows you the data in terms of earning forecasts at different points of time. Nothing much to say except to say that the earnings forecast for FY25 have been very, very stable at the end of every quarter over the last 1 year. Those are the 4 bars you see in the middle, extremely stable, no cut to earnings forecast, which has typically been the pattern. We'll jump through now to the slides on valuation. With the rally that happened in June, the Nifty on the left-hand side on trailing P is now kissing that red line in terms of being expensive. But the fact of the matter is that the forward P anyway at 21 times remains in fairly expensive territory for the Nifty. Next slide shows you price to book. Again, record levels of being expensive for the Nifty 50. Having said that, keep in mind this is also one of the best return on equities we have seen for the Nifty 50 in almost a decade, which explains some part of the Nifty trailing price to book. But it also then is implying that the ROE will stay very, very stable and never drop again. And we know that there are cycles to ROE, which is why this is a fairly premium price to pay. But having said that, take a look at the next slide. This shows you the mid cap and the small cap. And in a relative sense, the message from this is that mid caps and small caps far more expensive. And if anything, it's really the large caps which give a lot more comfort in terms of valuation relative to the mid caps and small caps. This is in fact something that we published a blog by just earlier this week by Karthik, who runs UTI Large Cap Fund, and Vishal, who runs our UTI Focused Fund. They published a joint blog together in which they talked about why they think the opportunity today is in large caps as compared to mid and small caps, and valuations play a significant role in that. Moving on to the next slide, this shows you the positioning of Indian equities versus Indian bonds. Suffice to say, the current yield difference at 2.22% points towards fixed income being favorable as compared to equities. Next slide shows you large caps versus mid caps. Yeah, okay, we've already jumped that slide. So we'll go straight to the summary slide. Just wanted to highlight the budget will be presented later this month. The expectation is that the government might make some fiscal tweaks, but most importantly, the messaging will remain one of fiscal discipline, and therefore they will retain the target of 5.1%. They do have some flexibility in terms of expenditure, because compared to the interim budget, the actual dividend receipts that they have got are much higher, and therefore there is room for them to spend in different revenue and capital expenditure heads based on the choices they make. That will be interesting to watch. The policy rate premium to CPI is quite significant, and we think this basically means it's a question of when the MPC cuts rather than if. Further, if the government sticks to the path of fiscal discipline, it actually enables the Monetary Policy Committee to think about loosening monetary conditions later this year. We've already talked about valuations and the dichotomy. Best thing for investors to do would to follow a staggered approach. If you do wish to invest lump sums, then consider strategies like the balanced advantage, multi-asset and equity savings, simply because these are funds in which we are managing the asset allocation and the allocation to equity based on valuations. Between large, mid and small, our bias is towards large caps. At a sector level, the preferred sectors are banking and financial services and healthcare. Banking and financial services are attractively valued relative to growth for absolute returns, and healthcare on a relative basis, we still think, given the breadth of investment opportunities, remains interesting. Also, finally, we do run a thematic fund, which is the Innovation Fund, which invests in many companies that will benefit from ongoing transformational changes in the economy. These involve internet and technology-based businesses. They involve businesses which are involved in climate change. But it is a volatile and concentrated portfolio, but investing through SIP in this strategy, we think can have certain long-term rewards accruing to investors. So that's about it from my side in terms of a broad picture of the macro and what we think about valuations and investment strategy. I'll now hand over to Amit Premchandani, my colleague and fund manager. As Niranjan said, he manages the UTI Value Fund and the UTI Dividend Yield Fund. He's been a banking analyst in the past as well, and he's been with UTI now for, I think, over 15 years. So he's one of our veterans, both in research and fund management, and he'll talk about his investment strategy today. Over to you, Amit.
Thank you, Vetri. Thank you, Niranjan. Good evening, everyone. Thanks for listening in. As you all know, UTI Value Fund follows a value investment strategy. The fund has been following the principle of intrinsic value. And we use a very simple definition of intrinsic value. For us, it means the discounted value of the cash that can be taken out of the business during its lifetime. The way we manage the UTI Value Fund, the portfolio construction is primarily through three levers. The first lever is we use sectoral allocation, valuation filter for sectoral allocation. For example, the decision to go overweight or underweight in a sector is largely driven by valuation consideration. We focus more on asset-based matrices for cyclical sectors and earning-based matrices for less cyclical sectors. If you can just go, Niranjan, if you can just go to the next slide, please. Yeah. For example, in case currently large private sector banks have seen significant correction in multiples on relative basis as well as absolute basis to some extent over the last 2 years, especially with related to the broader markets. And this has been on the back of very high return ratios, one of the highest in the last decade. They are reporting double-digit loan book growth, very low credit cost, and also having high capital adequacy. So all the macro trends are in favor, and still the sector is getting derated. This qualifies as value from an intrinsic value point of view for a value fund, Hence, we have very large overweight, especially in private sector bank on a sectoral basis. Broadly, our sectoral approach can be compared to the online sales of Amazon, Flipkart, where products are available at 25 to 50% discount of similar brands which were not available during non-sale period. So we generally try to use short-term headwinds to provide, these short-term headwinds provide us a trigger to act. The second lever is the barbell that we use. It is used primarily for stock selection. Here, we have made an important change over the last few quarters. Earlier, we used to have a kind of a very good balance at both ends of the barbell on the growth as well as on the cyclical side. We have, over the last 1.5 years, gradually moved our portfolio to have more distinct value and cyclical flavor. We continue to own companies and two different set of companies, but the balance now remain more tilted towards value or cyclical stocks. The extent of that tilt will vary based on our judgment of where we are in the cycle. Here we continue to invest on one hand companies which are going through cyclical downturns or with limited terminal value risk. And when the market is excessively focusing on a particular downturn, ignoring the long-term potential, we kind of act on that stock. And at other end of the barbell, we are continuing to invest in companies which are very long runway for growth with a very strong franchise. Relative to expectations, at both ends of the barbell, companies are relatively cheap at growth end as well as on the cyclical end. We continue to avoid companies which can have terminal value risk as well as having any balance sheet risk. We are generally having an analogy, give you an analogy, we are participating in both Pantaloon and Zudio kind of fashion at one end, as well as a shopper stop kind of a fashion at another end, while avoiding V-Marts or Palladium malls at both sides of the barbell. Structurally, as I mentioned, the share of Pantaloon kind of a fashion is increasing, given that we are having a more value or cyclical orientation in the portfolio. The third lever which we use is basically move across market cap. This lever is used sparingly. We have been having 18 to 35% range in terms of small and mid cap. We have been consciously reducing our mid and small cap exposure. But what is happening is that we have a very large exposure in the consumer durable segment, and most of the companies in that segment that we own are small cap. And we expect these companies to come out of a cyclical lows. In addition, there are frequent changes in formal market cap classification, which also distort the number and reduces our or increases to some extent our small and mid cap allocation without we actively pursuing anything. One thing which we have changed in addition to these levers over the last 18 months is that we have taken a more measured view of terminal risk of few businesses, especially in the energy space. Especially during the last 2 years after the Russia-Ukraine war, we have seen globally energy as a space coming back, and the terminal period of many of the energy-related companies have got extended ahead. This change in the terminal period of some of these energy companies is also reflected in the portfolio through higher allocation to energy as well as the metal companies as far as UTI value fund is concerned. Overall value as a theme, if you see, Niranjan, if you can take to the previous slide, value as a theme has done really well over the last, almost 20 years. This is the Nifty 500 value 50 stock indices performance as compared to Nifty 500. As we can see that Nifty value index has done much better than the 500 indices over a long period of time. But on the other hand, we can also see that generally the standard deviation or the volatility of value as a style is much higher than the broader Nifty 500 index, which is a combination of all the styles and a much more broader portfolio. So value as a value can be value has much more risk, higher risk in terms of excess volatility. And UTI Value Fund is trying to manage a portfolio in an approach to the barbell strategy to reduce this high volatility which comes inherent in a value strategy. If you can see the exposures that we have across sectors, how we are using the sectoral allocation approach, using the value as a value as a benchmark, you can see that auto as a sector we had a very large overweight over the last say 2 to 3 years, and as the valuations have inched up and moved sharply, we have reduced our exposure over the last 1 quarter and moved underweight. Similarly, on the other hand, in banking and financial services, again, we have used a broader multiple as a lever, a sectoral multiple as a lever to increase weight in banking and financial services, given that at a sector level, banking and financial services is not expensive, and hence we have much higher weight in banks and financial services. Niranjan, if you can move the chart yeah, and then in the next chart, please. In the capital goods sector, clearly we can see that valuations have inched up significantly at a sectoral level. The sector's valuation has almost moved 4x from the lows. And over the last 1 year, we have been cutting our exposure to capital goods as a sector, showing how the primary lever of sector allocation is used, valuation is used in sector allocation as a lever to move around the exposure. So we have a very large underweight on capital good as a sector, largely driven by valuation call. How we use the intrinsic value in practice is we have developed guardrails and margin of safety in terms of how we use these approaches. For example, we use operating leverage to invest in stocks. For example, auto is one sector where we were focusing on auto leverage, operating leverage, thinking about when volumes come back, margins will move up sharply, and hence we had significant exposure in some of the auto-related OEMs. Similarly, we use option value to focus on certain sectors. For example, there is one sector which has seen significant consolidation, and the larger dominant player in that sector is expanding from movie screening to providing a overall experience in terms of entertainment as well as food options. So this food option is coming as an option value in that company. Again, what we try to avoid is to avoid balance sheet risk when we are looking at intrinsic value approach. For example, whenever there is a significant increase in working capital in some of the sectors, we try to avoid companies in that sector. For example, in the construction sector, we have kind of moved out of one of the companies because of our significant balance sheet stress. As far as if we can just show you examples of how this barbell is used in practice. For example, in IT, we have one company which is much more cyclical, which has low margins and going through transition. And on the other hand, we have a company which has been reporting strong growth over the last few years, consistent growth, and one of the best in class in terms of large deal wins. Similarly, in auto sector, we have two-wheeler players. One is a much diversified player, and another is on the premium end of the two-wheeler segment. You may see the multiples converging of cyclical as well as growth stock. But when we enter into these exposures, there is distinct differentiation between the companies at that point of time. In terms of other sectors like pharma as well as banking, we have similar exposures at both end of the barbell. Yeah. Niranjan, if you can just move. So if you can, the third lever that we use is the market cap allocation, and there has been hardly any change because we have been reducing our exposure to small and mid cap. But because of the sharp rally in small and mid cap, what is happening is the overall allocation is hardly changing, and we have very large exposure in consumer durables, which largely is sitting in the small cap segment. Yeah. As far as valuation is concerned, we focus on price to book as a valuation measure to see where we are in the cycle, how we are exposed as compared to the benchmark. We use price to book as a preferred metrics because it is less volatile. And you can see that now we are almost 35% below the benchmark. One important point to note is that over the last 1.5, 2 years, we have seen that the valuation dispersion between quality and value or cyclical stocks have actually reduced and in some cases reversed. What were traditionally cyclical or value stocks have actually, in some cases, started trading at a premium to some of the more growth-oriented companies. Especially, we can see that stark change in banking and financial services, where some of the NBFCs, which were government-owned, are trading now at multiples which are almost at a premium or actually at a premium to some of the large private sector banks. Yeah, next. These are generally the trades or the exposures that we have entered and exited over the last, say, 1 year. As you can see, over the last, especially 6 months, we have increased our exposure to some of the large cap names, especially in the oil and gas segment or in the metal segment. We have increased our exposure or entered some of the companies. And in small and mid cap, we have focused more in sectors or companies which are attractively valued. For example, EPC is one sector, construction is one sector, where we have seen a slowdown in order inflow in the last 2 years because of the impending election. And we expect that slowdown to reverse now, given that the mandate is in place. And hence, we have entered an exposure in that segment. We have moved from one AMC, which which has a 40% share in mid and small cap of the overall AUM, to another AMC, which is much more diversified and much more reasonably valued. Again, moving within the sector, we have increased our exposure to a T&D theme, power sector, through the largest transmission and distribution company. So these are broadly exposures that we have taken at a sectoral level. We think that auto and auto component is one sector which where we think that a cycle has largely, earning upgrade cycle has largely played out. Volume growth has come, margins have seen improvement. We have the view that especially in the passenger vehicle segment, the cycle has peaked. Hence, we have reduced our exposure in auto and auto components, and we are now underweight. On the other hand, BFSI is a sector which provides valuation comfort, as I had already explained, and you will see that we have consistently increased our exposure in BFSI, especially in banks, private sector banks. And private sector banks are now, if you look at the subcomponent, are a very large overweight of almost 5% in the overall BFSI space. Within the broader consumer theme, we have increased exposure to consumer staple, but it is only marginal. We think that the sector has high ROICs, low requirement for capital, but it is still having a very high implied growth, so which is not providing us comfort to actually move into overweight. While on the other hand, durable is a segment which has seen high erosion in margins due to high competition and low volume growth. And while we think they are durables are late stage real estate play, and as real estate gets delivered after completion, we think that the demand for durables will increase, and the durable as a sector will see a cyclical uptick as the cycle revives. So we are underweight in staples and overweight as far as durable is concerned. In IT broadly, we are having only a marginal positive overweight. Valuation is not cheap, but it has corrected significantly over the last 2 years. Implied growth is now much more reasonable. Sector continues to have high free cash flow yield, high dividend yield, and one of the best ROICs. So, despite having a valuation which is significantly higher on a decadal basis, although much cheaper over the last 3 years, we still have only a marginal overweight. One weight which we have increased over the last 1 year is oil and gas. The main reason was better visibility of earnings in some pockets of oil and gas and marginal revival in growth, especially in coal sector, given that we have seen volume growth, and CGD sector, where again we have seen a revival in volume growth. Traditionally, the sector has low growth and high capex and high dividend yield. But given the fact that this sector is on a long-term basis a low growth sector, we have increased our exposure significantly, but still kept underweight exposure. Metal and mining is another sector where we have increased exposure and moved overweight. Companies across this sector has seen significant decline in leverage. The down cycle margins are much higher than the previous cycle, and it's a much cheaper way to participate in the capex revival in India. And as you can see, that capital good is one sector where we have significantly increased our underweight and booked profits in many capital good companies that we used to own, because valuation became really uncomfortable in this segment. All right, yeah, next slide. So you can see the portfolio largely there we have high active weights in some of the large banks. Most of the active weights on the top 10 are in large cap companies. And we have a very unique company on the small cap side, especially in the durable segment. Next slide, please. Oh, sorry. Yeah, so overall, if I can just summarize, over the last 1 year, we have moved the portfolio into a more value-oriented theme without compromising on our key principle to focus on cash flows. The major movements have been in the oil and gas sector as far as portfolio allocation is concerned. We have seen a significant allocation, but we have kept the hygiene requirement of cash flow, strong cash flow, even in the oil and gas segment in mind. We have a portfolio which has lower standard deviation as compared to the benchmark. And the past performance of the portfolio also suggests that during market sell-off, our portfolio is relatively better quality value portfolio, which invariably has a better downside protection. We have tried to balance that through our allocation to oil and gas sector, so that we also capture the cyclical elements as well as the core value elements which are available in the market. The portfolio has almost 55 to 56% exposure to the R1 segment, and almost 90% of the portfolio is having consistent cash flow and having a C1 profile. So I will just stop it at that, and I will hand it over to Niranjan so that he can take the conversation forward. Thank you.
Yeah, sure. Thanks, Amit, for such a detailed rundown on the value strategy and also UTI Value Fund. So, viewers, now we will move on to take the questions which are coming our way. So, in the next 15 minutes, kindly continue to post your queries, and we will try to take as many as possible. So, Amit, here is the first question to you. So, as you already alluded, so value fund in UTI Value Fund, the standard deviation is far lower. So, but as the fund endeavors to invest in mostly in undervalued strategies, both the buying and the exit strategy happens to be key for alpha generation, right? So, looking at that, how has been the portfolio churn in the past, and also how do you basically look at the reducing the risk in terms of standard deviation or other things?
Thanks, Niranjan, for the question. If you can just show the churn slide, you will see that over the last, say, especially 1.5, 2 years, our churn has generally slightly moved up, inched up, and it is on the higher end of the last, say, 5-year range. Our churn is much higher on the cyclical side or value side of the portfolio. Traditionally, it was much higher there and much lower on the growth side of the barbell. Over the last 1 year, what has especially changed is that it is continues to be the cyclical elements continues to have higher churn as compared to the overall portfolio, but we have become much more conscious on the growth side also, given that we want to keep a portfolio valuation significantly cheaper than the benchmark on a price to book basis. Earlier, we used to trim our allocation to growth-oriented stocks rather than exit. But now, given that we have a asymmetric approach in barbell strategy, where we generally have a much higher tilt to cyclical and value elements, we are having much more higher churn on the growth side also. We are having a much more strict threshold in terms of valuation, in terms of even the growth side of the portfolio. And hence the churn ratio has moved up. As far as the standard deviation is concerned, you can see that in the slide that our standard deviation of the portfolio is significantly lower than our benchmark. And this is again born out of the fact that despite us moving into more cyclical end of the portfolio or more value-oriented stocks, we have tried to maintain our hygiene of having operating cash flows or having a focus on cash flow orientation of the companies. And even if you participate in these kind of companies on the value side, they are less volatile given that they have strong cash flow characters. And hence, 90% of the portfolio is invested in almost 90% in C1 companies, which are having consistent cash flow, hence relatively less volatile.
Yeah, sure. Thanks, Amit, for that. So, Vetri, there is a question for you now. So, and as we have seen, India recorded the current account surplus in the last quarter of the last fiscal after a gap of 10 quarters now, right? So, and the growth in services export has actually outpaced the goods export and also defied the impact of the global growth slowdown, right? So, what is the implication for the long-term growth and the macro stability on this front?
Yeah, Niranjan. I would just say, look, fourth quarter for India is always seasonally strong. We are a trade deficit country. And secondly, any economy which wants to grow fast must invest more than its own inherent ability to save, which means you should run a current account deficit, and that should be financed by capital inflows from the outside world. So a current account deficit is not something to worry about, just as a current account surplus is not something to necessarily celebrate if you really need to step up your rate of investment. And as I said, in India's case, please look at it on an annual basis, not on a quarterly basis, because there are seasonalities. But I think the good news that I would take away from this is some current account deficit is good because you are bringing in capital, which allows you to grow faster. Too much is a bad thing. The RBI's comfort historically has been CAD less than 2%. Right now, we are running more at a 1%, 1.5% annualized level, which is a good level to keep it at.
Sure. Thanks, Vetri. So, Amit, since you've been tracking the banking sector closely, right? So, there's a question on that. So, the deposits actually lag the credit growth as savers look for higher returns option, right? So, that's the trend we have seen in especially in the recent periods. So, how is this trend likely to play out as it leads to significant margin pressure for the banks?
Thanks, Niranjan. Actually, deposit growth is not really related to savers using their savings to invest in equities or other higher interest-bearing instruments. because finally, if it is part of the system, if the money is not going out of the system in cash or out of the country, it will stay in the banking system. So the gap between saving and deposit is slightly started to narrow. And the regulator also wants that gap to narrow. If the currency in circulation moves up or FIIs have significant outflows, then the gap will continue to be high because actually the cash is moving out of the formal system through outflows or through currency in circulation. Finally, these lending and deposit growth numbers would converge. The gap could have got is higher still, mainly because of the PSUs who have much lower loan deposit ratio even now as compared to the system. So they have still some scope to increase the loan deposit ratio and continue to have higher loan growth as compared to deposit growth. But at a system level, we think that this gap will continue to narrow, and some of the private sector banks have to work harder on the deposit growth front and maybe take some market share or accelerated market share on the deposit side from PSUs rather than the accelerated market share shift that we have seen on the loan book growth. So we may see some decline in loan book growth from say 16% level to around 15% level, and some acceleration in the deposit growth from the current levels to a more sustainable level, so that loan deposit ratio is corrects itself. Many private sector banks are at 90% loan deposit ratio. Clearly, 85 to 90 is the peak on a sustainable basis, given that private sector banks have higher capital, so they can have higher loan deposit ratio as compared to private banks, as compared to PSU bank. But broadly, anything beyond 90% appears to be a stretch for even the private sector bank. I don't think there is any pressure point in terms of everybody has to put on brakes. It's just that they have to manage the balance sheet. Banks have to manage the balance sheet to ensure that they have a sustainable loan deposit ratio and it doesn't go beyond 90%. The largest private sector bank, after the merger, you can see that it has a loan deposit ratio of 104% now. So some element of pressure that you are seeing on the loan and deposit side is also because of a loan of an NBFC getting reported now as a bank, and that NBFC or a housing finance company did not have such a large deposit franchise or deposits as compared to the bank. So there is some and these liabilities have now to convert from borrowings to deposits. So that transition will take 1.5 years. So that will also reduce maybe the overall loan growth of the system, because that bank has to reduce the loan book growth.
Thanks, Amit, for sharing such a detailed view on banking space. So, in fact, in your presentation, you alluded to the terminal risk when it comes to investing in businesses out of particularly the oil and gas sector, right? So, while that's the case, when we actually look at the UTI value fund in the recent months, in fact, you have increased the allocation to oil and gas segment, while you continue to maintain underweight exposure, right? So what's your take on the sector and the opportunities on account of changing energy trade dynamics, and also the price differentiation and alternate currency options coming in this particular space?
So as you know that in the oil and gas sector, a large part of benchmark weight is to one of the largest market cap in the country. So if you leave that company aside, we have invested in that company recently, taken exposure. We had a zero exposure. We now have an underweight exposure. But overall, if you look at leaving that company aside, oil and gas sector is a low growth sector, and that is not changing. But 1 year back, that sector had significant, or perception was that sector had significant volatility in earnings, excluding the largest conglomerate. That volatility the perception is reduced because of conscious effort from the policymakers of letting the price of petrol or diesel be market determined, not 100% market determined, but at a point of time, if the oil price is within a range, it will be broadly, there will be marketing margins which will be positive for the OMCs. On the other hand, the oil explorers were not sure how much revenue they will get out of the oil explode. After the significant increase in oil price during the war or Russia-Ukraine war in the initial phase, there was a windfall tax which was introduced. And that windfall tax, elements of windfall tax suggested that after $75, till $75 per barrel of oil, government was or policymakers were comfortable to let the oil explorer, upstream companies keep that revenue. So a quasi floor of oil was, or the quasi cap of how much upstream company can keep was established through that windfall mechanism, which was around $75. Before that, people or market was assuming that that number can be anything, that can be $50 to $75. There was no clear guidance or clear policy. Even now, the policy is not cast in stone, but at least there's a windfall tax which is giving the market comfort that till $75 they will be allowed to make money. So that has created much more stability in terms of profitability and revenue pie of the upstream and to some extent the OMCs, yet the OMCs revenue or the profitability is much more volatile. Another sector or segment of the oil and gas chain is the CGD companies, the gas distribution companies. So these companies, there are two significant players which are listed, and we are seeing there is volume growth in one of the players coming back, and we are seeing more effort on the part of the government to focus on gas distribution or expand the gas distribution network. And these companies are also generating very high, decent ROEs, consistent profitability. And so we have invested in one such company, which exposure was not there. And given that there is a clear supply-demand mismatch now in the power sector, and thermal power demand is increasing, we thought a very good proxy to play the thermal power theme is through the largest supplier of the raw material of that thermal power, which had a very high ROE, very high dividend yield, and very strong cash flows. So that led to us investing in the largest coal extractor in the country. So these were some of the interventions we made in the oil and gas sector. But keeping all this aside, we know that this sector largely is a capital guzzling sector and a very low volume growth sector.
Sure. Thanks, Amit. Vetri, there is a question to you. So, in fact, the Indian equity valuations have reached the new milestone, and it has opened some concerns of earnings growth moderation in certain pockets. So, while the combination of earnings and liquidity shall shape the near-term returns, which are the sectors that are vulnerable on account of valuation today and also expected to see some meltdown or correction?
Thanks, Niranjan. I wish I had a forecasting method that would tell me what will go up and what will go down. That's impossible to know beforehand. I have no such special skills. But what we do know is that high valuations and and sectors which already have high returns in the rearview mirror typically tend to end up disappointing, those that already have poor trailing returns and comfortable valuations, even though news flow might not be good, typically tend to have much better outcomes. That's why, banking and finance, when I covered, I said is one of the sectors where we think absolute returns still look attractive, and there is still scope for that. But on the other hand, if you were to look at an area like capital goods, and widely speaking, the industrials area, that is an area where I would say valuations are now very, very challenging. And really, I think the best of the hopes in terms of growth prospects, growth in earnings are all captured in those valuations. So, the potential for returns is already captured in the price. You should be asking what from here. And that, to my mind, is a bit of a concern. Not a forecast on something melting down, just that I think the good news is already in the price.
Thanks, Vetri. So in the interest of time, I think we will take the last two questions for this evening. So Amit, there is a question to you. So this is on the consumption cycle. So we have actually seen the consumption cycle slowing down in the recent past, despite the improving GDP numbers, right? So what are the headwinds in the consumption sector delaying the growth? If you can share some views there.
So we have seen over the last year, especially after COVID, there has been a K-shaped kind of a recovery where consumption in the luxury or premium segment kind of accelerating back, while consumption on the lower end segment kind of continue to see some pressures. And we have seen that pressures in low end cars, low end two-wheelers, and in the staple companies. While we have seen strong growth in high-end SUVs, high-end cars, real estate, and even on the two-wheeler side, higher-end bikes. And in the overall consumption pie, we think high-end malls have higher growth as compared to low-end malls, where at an overall scale level. Consumption growth has been subpar over the last, say, half a decade. But if you have to keep this in mind as compared to the previous half decade, in the second half of the previous decade, actually CapEx growth was muted, and capital expenditure was relatively muted as compared to consumption. So that is more likely balancing out. Second, because of the huge impact of COVID, especially on the savings of the low income part of the population, their balance sheet got deteriorated because of that, and they are on the recovery phase of that balance sheet deterioration, which is again getting reflected in the low consumption number. What we have seen over the last, say, 1 year, especially over the last 6 months, is that there have been significant, or there have been some intervention by state government by increasing handovers through specific targeted schemes, especially in the lower strata of the society, so that their consumption or their purchasing power is kind of kept. Last year also was there was a huge slowdown on rural India because of the poor relatively agriculture growth. If this year monsoon are decent, and as we say, the impact of these measures by various state government playing out, we think that rural growth should revive, maybe already revived, because we have seen the largest OEM saying that their rural growth was better than urban growth. Some of the staple companies have already started saying that their rural growth was better than urban growth. So we may see, we are maybe on the or verge of seeing improvement in consumption growth, especially on the lower side, lower strata of the society. But overall, yeah, we are not seeing any significant pickup overall in the overall consumption as a theme, and it continues to be muted, and there is no significant trigger which is kind of visible. The budget is coming. We may see a tax cut on the direct tax side, which may again kind of create a positive impact. But again, we have to keep in mind that recently there have been a significant increase in telecom tariff after 3 years of muted increase. There was almost 15-20% increase. That pool of increase in telecom is now is no longer a luxury; it's a need. and the revenue impact of that increase in tariff is almost anywhere between 30,000 to 40,000 crore. So a pie of consumption will be used to increase. It's an essential commodity now, telecom services. So 40,000 crore will move into telecom services, which again reduces to some extent the ability, especially in the lower strata of society, to consume something else. So there will be again a rejig there.
Sure. Thanks, Amit. Interesting insights. So we will take one last question for this evening. There's a question to you, Vetri. So after this production-linked incentive, we are expecting the employment-linked incentive. Maybe this could be instrumental in encouraging micro and small and medium enterprises. And probably it can be a potential to create a large number of jobs in the country, right? So do you think the government is now ready to roll out the reforms in this front? And also, what are the other reforms you are watching out in the budget scheduled this month?
Well, point number one, Niranjan, is budget is not a forum to unveil reforms. Budget is a decision of government as to where they will collect taxes and how they will spend them. So I think this focus on reforms in the budget is completely misplaced. There are many things which can be done outside the budget, and I would actually say look at the history of many things that the current government and previous governments of India have done. They've all happened outside the scope of the budget. So we should not think of this from the limited point of view of the budget. Second point, I think, it is actually very unclear to me is what are the really dramatic second level or second generation reforms that need to be done. I think a lot of enabling factors are already in place. I think what we need is a single-minded focus on execution. We need a single-minded focus on ease of doing business. If we make it easier for companies to invest, grow, and employ people, they will do it. I don't think any dramatic second generation reforms are called for at this point of time. There would be many which could be done, but we have to see what is politically feasible, what can be done, what will have certain other constraints. So I would say focus on execution. That to my mind is the mantra.
Great. Yeah. Thanks, Vetri. So with that, I think we have reached towards end of this webinar. So thanks to you, Amit, as well, and the viewers for your participation and for the questions. And certainly your questions help us to make the webinar more engaging and interactive as well. So in case if we have missed any of the questions that you have posted, kindly you can also get in touch with your relationship managers or our distributors who will be more than happy to assist you with respect to update on our funds and strategies as well. And also, in case if you missed any part of this webinar and wish to view, the content will be available on the YouTube channel as well. So you are free to go back and look for the same as well. And just finally, a request to our viewers as well to use the feedback link, which is actually available on the screen, to share your feedback, and we will certainly look into them, and it will help us to do well in the upcoming webinars as well. So with that, thanks everyone, and thanks Vetri, Amit, and the viewers. So this concludes the webinar, and good evening.
Good evening. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.